Imagine buying your dream home only to find out you can't get insurance, or that your insurance premium just doubled overnight. While thousands of California homeowners are facing this exact situation right now. This crisis isn't just about rising costs. It's about whether millions of Californians can even keep their homes, and if the market cracks here, it might not stop at California. And now, after the devastating LA fires, the situation is even worse. But what happens when insurance companies start treating entire neighborhoods as uninsurable? When home values begin to collapse overnight? The answer is far worse than most people realize. The damage from these fires has forced insurers to reassess their risks, leading to even higher premiums and more policy cancellations. Homeowners who were already struggling to afford coverage are now finding themselves completely uninsurable. Major insurance companies are abandoning California. Homeowners are getting hit with massive premium hikes, and now some homes are becoming completely unsellable. Today, we're breaking down how California's insurance crisis is crushing home values, making mortgages riskier, and why it could lead to another housing market crash. California has always had wildfires, but in recent years, they've become more frequent, more destructive, and more expensive. With hotter temperatures and drier conditions, fire season lasts longer than ever. This has led to billions in damages, and insurers are feeling the heat, literally. For homeowners, this wasn't just a price hike, it was an ultimatum. Find another insurer or risk losing your home altogether. But what if the only option left is barely an option at all? First, insurance claims exploded, then the biggest names in the business, State Farm, Allstate, Farmers, they all pulled out. Now thousands of homeowners are stranded with just one option, the FAIR plan. Higher premiums, less coverage, no alternatives. California has strict regulations that limit how quickly insurers can raise their rates. While this was meant to protect consumers, it has backfired. Insurers can't adjust premiums fast enough to keep up with rising risks, so they're opting out altogether instead of operating at a loss. Well, if home insurance becomes too expensive, homeownership itself becomes unaffordable. Let's say you can afford a $3,000 mortgage payment, but suddenly your insurance jumps from $150 to $600 a month. That extra cost means you now qualify for a smaller loan, or you might not qualify at all. This pushes potential buyers out of the market, leading to declining demand and stagnating home prices. But here's the terrifying part. If your insurance company drops you, your mortgage lender won't just let it slide. They'll force you into a backup plan, one that could drain your savings and push you toward financial ruin faster than you think. Lenders won't give you a mortgage without insurance. If you lose your policy, well, the bank might step in and force you into force-placed insurance, which is insanely expensive and can add thousands to annual costs. Well, if you're a buyer and you find out a home costs $5,000 a year just to insure, you're going to think twice about making an offer. Demand drops, sellers lower prices, and boom, home values start falling. And what happens when buyers stop buying? Well, the answer could send shockwaves across the entire US housing market. The 2008 financial crisis was driven by reckless lending, subprime mortgages, and financial speculation. When the housing bubble burst, millions of homeowners found themselves underwater on their mortgages, leading to mass foreclosures and a banking collapse. In 2008, the housing market crumbled under reckless lending. Today, well, a different force is threatening to destabilize the market, and this time the warning signs are already flashing. Unlike 2008, today's homeowners generally have more equity, and lending standards have been tighter. However, the insurance crisis presents a different kind of risk. Homes becoming unaffordable due to insurance costs, leading to market slowdowns, distressed sales, and a potential regional price collapses. If enough homeowners cannot afford their insurance premiums, well, we could see a wave of forced sales. If these homes sit on the market too long, prices will start to drop. That could trigger a psychological shift where buyers wait for even lower prices, leading to a downward spiral. And when that happens, it won't just be individual homeowners feeling the pain. The entire market, including you, could seize up, triggering a cascade of collapsing home prices, panic selling, and a financial ripple effect far beyond California. If investors also pull back, especially large corporate landlords who have been buying properties in bulk, well, we could then see liquidity in the market dry up. This would further drive price declines and create a regional housing crisis that could spread beyond California. If home values drop, homeowners will see their equity shrink. Some may start defaulting on their loans. If defaults rise, banks and lenders will become more cautious, tightening credit standards. This could slow down the entire housing market, similar to what happened post-2008. But is there a way out? Or are homeowners trapped, watching their home values crumble with no way to escape? Well, the truth is, there are strategies if you act fast. If you're already a homeowner in California, well, you have a few options to protect yourself from rising insurance costs and potential market instability. Shop around for better insurance rates. Some insurers still offer competitive rates if you take steps to mitigate risks. Invest in wildfire mitigation. Home hardening, fire-resistant materials, and defensible space can qualify you for insurance discounts. Consider selling before prices decline. If you're in a high-risk area, selling now could protect your equity before prices potentially drop further. Refinance or lock in a fixed-rate loan. If you have an adjustable-rate mortgage, locking in a stable payment now could help protect against economic instability. Well, if you are considering buying in California, here are some things to keep in mind. Factor in insurance costs. Get quotes before making an offer to ensure affordability. Look for low-risk areas. Some regions have lower wildfire risks and more stable insurance options. Negotiate for seller concessions. If you're buying in a high-risk area, negotiate with the seller to offset future insurance costs. Think long-term. If the market declines further, make sure you're comfortable holding onto your property for at least 5 to 10 years. If you're an investor, be mindful that California's insurance crisis could lead to unexpected losses. Diversify your portfolio and be cautious about over-leveraging in high-risk markets. Adjust ROA calculations to include higher insurance costs. What was once a profitable rental may no longer make financial sense with increased expenses. Consider selling before institutional investors pull out. Large-scale investors exiting the market could accelerate price declines. Monitor policy changes. If California enacts new legislation to stabilize insurance rates, it could impact the market in either direction, really. So look, California's insurance crisis is making homes unaffordable, driving prices down, and could trigger a housing crash. California is the first domino, but it may not be the last. If this crisis spreads, your home, no matter where you live, could be next. The big question is, will it spread to the rest of the country? Will we see other states with high disaster risks like Florida, Louisiana, or Texas face similar insurance-related crashes? Have you felt the squeeze of rising insurance costs? Have you seen homes in your neighborhood sit unsold? Well, share your story in the comments, because the more we talk about this, the more we push for solutions. And if you found this video helpful, make sure to like, subscribe, and hit the bell so you don't miss the next one.